Welcome to today's webinar, everyone. Thank you for joining us. Today's Cultivating Success webinar is on financial fitness for farmers, and we're going to be talking about balance sheets. This webinar is part of a partnership from the Cultivating Success Program, and the partners are University of Idaho Extension, Rural Roots, Washington State University. Today's presenter is Kate Peener. Kate is joining us from Boundary County, so Bonners Ferry, our most northern county in Idaho. I'm Colette DePhelps, and I'm your facilitator today. I'm located on the Moscow campus. So, webinar tips. If you close a program computer that might be using some of your internet bandwidth, that could help with your clarity and speed. If at any time you're having trouble with your sound, you can use the call-in number provided in your welcome email and listen via your telephone for your audio. If you do that, it'll work best if you mute your computer sound so you don't get feedback. You can type questions into the question and answer box, which is located in the control bar at the bottom of your screen. You can also type any questions or requests for help in terms of technical issues in that box, and I will be moderating that and responding throughout the webinar. There are handouts related to this webinar that I emailed out to everyone yesterday. They will also be available through the Cultivating Success website. If you did download those handouts and print them, or you have them available to view during this webinar, that will be helpful to you. So with that, I'm going to go ahead and hand over the webinar to Kate so that she can talk about this series and then jump right into balance sheets. So, Kate, if you'd like, you can go ahead and...
I can't share it yet. It says that I can't start it while you're sharing.
Oh, I thought you were going to talk about the 4-part series before I stopped sharing.
Right. Sorry. Okay. Hi, this is Kate. I am an ag economist by training, and I am an ag extension educator in Boundary County, and doing this farm management series is one of my favorite things. So I'm really happy to be here doing this series. We're starting with balance sheets, and then next week we'll look at income statements, which tie the two balance sheets in today. We're going to be using an example based on my sheep farm. I also have extensive experience raising hand spinning sheep. And then the third presentation will be on enterprise budgets, probably one of my favorite topics. It's basically a story problem. The more complicated, the better from my standpoint. I love to do them. And then the last one will be on cash flow statements.
Great. Thanks for doing that overview, Kate. And I went ahead and stopped sharing my screen so you can share your screen.
Okay, so I will jump right in today, and we're going to talk about balance sheets. I have a lecture, and then I have an exercise. So if you really want the points to gel with you, I would suggest that you kind of play with the exercise, which we'll do to some extent at the end. When we did this in the classroom setting 2 years ago, it was 2 hours devoted to each topic. So this is a little abbreviated. A balance sheet summarizes the financial condition of your farm at one point in time, often January 1st of each year. It is a snapshot. It estimates your net worth. That's one thing it does. And most of the things you do will affect your balance sheet. It can change daily. There are several purposes of a balance sheet. It is one of the main financial statements that you would take if you were going into the bank to get a loan. It calculates the value of everything you own as well as everything you owe. And the difference between the two is your net worth. And that is also called owner equity. Owner equity is your assets minus your liabilities. Okay, so let's define these terms a little. An asset is anything of value that you own. A liability is a debt or other financial obligation like a loan that you owe to someone else. And then owner equity or net worth is total assets minus total liabilities. So this balance idea is you have owner equity is equal to assets minus liabilities. Okay, let's do an example that I think will make it easier to understand. Let's say you only have one asset. This is this beautiful pink tractor. It is worth $5,000. You paid $1,000 down on it today. What is your net worth? Okay, let's use this balance sheet format to make it easier. Your asset is a tractor worth $5,000 in the left-hand column. And on the right-hand column, you start with your liabilities. You owe $4,000. And then the difference to make those two sides balance, well, your equity in this tractor at this point is the $1,000 that you paid down. So your assets minus your liabilities is going to equal your owner's equity. And this is the standard format with the assets on the left, the liabilities listed out, and then owner equity added to the liabilities, and the sum is $5,000 on both sides. So the left-hand column equals the bottom of the right-hand column. So an asset is anything of value that is owned. It can be sold to generate cash. It is typically used to produce other goods like land and livestock are very common assets, and you use those to produce, in my case, lambs and hand spinning fleece. Okay, so they're broken down into current and non-current. Goods that have already been produced and can easily be sold, but that will probably be sold this year, for example, would be hay or produce. In my case, my fat lambs, my lambs that were ready to be sold for slaughter, but not my ewes, not the moms. And then non-current assets refer to your goods, your assets that are long-term, like machinery and equipment, breeding livestock that you keep from several years. Buildings is another example of a non-current asset, and land. These are more difficult to sell quickly and easily at their full market value. Okay, liabilities, that's a debt of some kind or an obligation owed to someone else or some outsider's claim against one or more assets of the business, like accrued taxes. And when I see the word accrued, I think accumulated. So you're accumulating a tax debt throughout the year. As you make money, sell things, you know that your taxes are accumulating and you will be owing something at the end of the year. And just like current assets, current liabilities are divided into those that will be due and payable within 1 year, such as bills payable locally, loan payments due this year, so you know what you're going to have to be paying out this year. It's important to distinguish those. And your non-current liabilities, like you might have guessed, are obligations that don't have to be paid in full within the next year. For example, it could be the remaining balance on long-term debt. We'll look at examples that will make it sink in better. Okay, and an owner equity is defined as the amount of money left for the owner if the assets were sold and all liabilities paid. That is also called your net worth. And it basically represents your current investment in your business. For example, you could think about the pink tractor. The net worth or owner's assets on that, owner equity in that is $1,000. That's what you have invested in it at this point. Okay, so we're going to talk about what would change your owner equity. If the value of an asset changes, for example, we'll look at how depreciable assets, their value declines over time, like might have a 5-year life or a 3-year life for a breeding ram or a bull, and you depreciate out the value of that over those 5 years because it is going down in value, and you need to know that it is a cost even though it's non-cash. And another thing that changes your owner equity if something is added or withdrawn from the business, like a cash withdrawal, or you earn profits from your business. In the case of my sheep farm, as those ewes had lambs, they're adding to my owner equity. Or if you get an inheritance that you put into your business, then that would also increase your owner equity. Okay, on the other hand, what would not change your owner equity? And this one's a little odd to think about until you think of your the way that balance sheet is laid out. If you pay a debt, it doesn't change your owner equity because you're withdrawing funds from the asset, like your bank account, and you are reducing a liability. So the asset goes down by the same amount as the liability. That's kind of a standard farm management test question. There's no change in owner equity from paying a debt. Okay, so the reason we do balance sheets is often the bankers want to see these, and you would want to know as well what's happening to your business and how it compares to others. You can see over time, is your owner equity going up? Hopefully it is. One hates to see your owner equity being eroded. That means something's not going well. Your business isn't sustainable if the equity is eroding. So lenders use these to make lending decisions and monitor your financial progress. Okay, we're going to use a little pink tractor as a very simple analysis, and we're going to look at the debt to asset ratio. And that's simply total debt divided by total asset value. In this case, we have $4,000 owing and $5,000 is the worth of the total asset. So the ratio is 0.8. Ideally, your liabilities make up no more than half of the total value of your assets, which is not the case. You just bought this tractor and your debt to asset ratio is 0.8. You'll have to pay it down more to get to less than 0.5 on that example. It makes you risky if you've got a lot of debt and not much in the way of assets. If you defaulted, there would be much that the bank could get out of your what's left of your assets if you had to default. So another ratio is equity to asset. And in this case, you take your total equity and you divide it by your total assets. In this tractor example, your equity is $1,000 and the asset value is $5,000. So you don't have much equity in that tractor yet. The ratio is 0.2. And again, ideally, your equity should be more than half the total value of your assets. Actually, it's in the other case, you want it to be less than half. But in this case, you want your equity to asset ratio to be greater than 0.5. And that makes sense. You've got more value out of that asset that you own. A high equity to asset ratio makes you a less risky client for a bank lender. We all want to have less debt and own more. So these are really interesting measures. These last two ratios basically looked at solvency in terms of what is your debt. What is your debt compared to your assets and your equity compared to your assets? Since they're ratios, you can compare across operations of different sizes. and it'll still be valid. On the other hand, liquidity measures your ability to meet your cash flow needs. The current ratio is current assets divided by current liabilities, and working capital, another measure of liquidity, is current assets minus current liabilities. I'm going to talk a little bit more about these. Your current asset to current liabilities ideally is greater than 1. So you own more than you owe. Again, because it's a ratio, it's the same for both large and small businesses. Working capital is somewhat different, though. It is current assets minus current liabilities. You need a comfortable margin so that you can meet your debts as they come due. And the appropriate amount will depend on your size. Obviously, large farms would need more working capital than small farms. Okay, I've kind of raced through this presentation, so we'll have time for going through an example or two, and it'll help digest this material, and we'll also have time for questions. So a balance sheet measures the financial position of a business at a single point in time. Ratios of debt to equity and assets to equity compare your firm to others, regardless of size. Okay, now here's time for the story, and this will be a lot more fun. All right, so if you have the handouts that went with, I'm just going to read a little bit of the story. This is based on my sheep operation, Kate's Rambouillets, and at the January 1st of 2019, this is the current assets. I'm just going to give you a little background. I raised hand-spinning fleeces and lambs and occasionally guard dog puppies. It shows as of January 1st that I have $2,200 in cash and checking, and then $750 in prepaid expenses and supplies, prepaid feed and supplies, which would probably be hay and grain for the most part. I also have $200 in accounts receivable. In this case, it is a bill owing on puppies purchased in late December. Somebody owes me that, so it's an asset. Hopefully they'll pay up so I actually get the money, and then it will really be an asset. But anyway, accounts receivable are termed assets. And then I have some crops that I plan to sell in this current year. And I have $480 worth of hand spinning fleece and $800 worth of fat lambs. So my total current assets are $4,430. Okay, so since I've got January 1 of 2020 up, we'll talk a little bit about that. It's interesting because it's quite a different current asset position. $1,000 less in the checking account, quite a lot more value in feed and supplies, no accounts receivable, and quite a lot more inventory. So overall, the total current assets are about $1,800 more than they were the previous year. Intermediate assets on a farm, you often have things that have like a 3 to 7 year value, like breeding livestock, working dogs, machinery, titled vehicles, and the value of those go down over time. As you can see, they are depreciated out. The Border Collie is a perfect example. That is a $1,000 Border Collie with a 5-year expected life. So every year it is worth $200 less. And try to visualize that by the fact that you are using up $200 each year in terms of the value of that dog to your operation. So it's a non-cash cost, but if you don't do it that way, you're not really getting a true complete picture of your costs. And then the breeding livestock, their value goes down a bit each year. So does machinery and titled vehicles. So this is a real cost of production, and these can be quite large. Long-term assets are represented by the land and the barn and fences. And we've got $125,000 in farmland. Land does not depreciate, so it remains the same from year to year, but the barn and the fences definitely do. And there's tax laws, tax depreciation laws, and you can also do economic depreciation. But anyway, you have some sort of schedule that you're taking down the value of those assets as they get used up or depreciate. So a slight decrease in total long-term assets. Overall, there is about a $730 decline in total farm assets over the year. Despite the fact that current assets are up, we've got some decline due to depreciation. And in a farm, financial statements, especially a small farm like this, is very appropriate to then add in your personal assets. So the whole left-hand side of the balance sheet, in this case, it's got 2 columns, one for each year, so you can see what's going on and basically what we just went through. But 2019 to 2020 changes, decline in total assets. Basically, assets are being used up. But current assets actually show a pretty bright picture of the fact that you've got a lot of goods to sell there, and you've got a lot more feed on hand. But then the decrease from depreciation kind of takes away all of that value. You can see that your equity would be eroding if you had a lot of depreciation and not much growth anywhere else. Okay, on the right-hand side is your liabilities. And in this case, our current liabilities, the ones that are due this year, are represented by accumulating interest on the machinery and the mortgage. So they're $306 for machinery, and that's the same each year. The mortgage declines because the loan is going down from year to year, but the machinery was set up so it's even from year to year. Okay. Intermediate liabilities is the remaining term debt on your machinery, and that goes down each year by the value of your payment. The long-term liability is the mortgage, and that went down also from one year to the next in terms of the value of the payment. So the total farm liabilities went down. It looks like about $6,000 worth, $6,500 worth was paid off. Personal liabilities were $5,800, and those also were paid down to $4,800. So the total liabilities have gone down quite a lot. That's good. That means something's happening to allow you to pay down debt. Let's see how that all balances out. So the net worth in 2019 on January 1st was $125,449, and the net worth a year later was $132,219. So the change in net worth was a positive $6,770. So something is happening. That's good stories being told that despite the fact that some of your assets are depreciating, you're still having some good amount of productivity, that you're paying down your liabilities. The net worth change is positive. It's not huge. It's not a huge return, but your debt to asset ratio has improved. It was 40% a year ago, and now it's 37%. Okay. So what is missing from the story? It is the income statement. The income statement that we're going to do next week basically links January 1 of 2019 to January 1 of 2020. It'll show what happened to get from point A to point B, and it connects the two balance sheets. So you'll have to stay tuned for the next installment.
Does anybody have any questions for Kate? If you do, you can type them in the question and answer box. We haven't had any questions come in yet, Kate. Do you want to
Okay.
talk?
Yeah, I'm going to just talk about a few other programs that were in the works. And we have plenty of time for questions. So if you want to think of them, go ahead. But I want to talk a little bit about a grant that we're doing right now. It's a farm business management and benchmarking program. And it helps you create your farm's financial records. Basically, we have an assistant that was hired to work one-on-one with farmers. And in exchange for doing that, your benchmarking data is provided to FinPac. And it is a long-term project that's been going on for a lot of years. They're very professional. Your data is all scrubbed of any identifying characteristics, and then it is used to make broader averages for the industry. It's been done a lot in the Midwest, and we're doing it out here. And it's a great opportunity for people to develop their own financial statements. So I'll give you a link to signing up if you're interested, or you can email us for more information. So for more detail, there'll be one-on-one assistance to create and analyze balance sheets, income statement, cash flow, and budgets, and free access and training on FinPac, which is this business analysis software for farmers that's been going on for decades. And you also can get credit for beginning borrower training, which helps you get a lower interest rate if you go to USDA and get a loan with the Farm Service Agency. So what you have to do, it is open to any farm, any size. We're doing small farms as well as large. You provide your farm financial statements. You'll have to be working on gathering your data, and you will meet with someone, but you're going to have to do the homework to gather all your expenditures and your income and values of your assets. And in return, you'll have this whole farm financial analysis done. You will get a free trial of FinPac with training, so you can keep up this analysis, and you can get help compiling the statements if you need. So if you search for Idaho Ag Biz in your Google search engine or wherever, it will come right up, and this is the link. But you can just search for Idaho Ag Biz and you will see the announcement and you can sign up.
Great. Thank you, Kate. We actually had a couple questions come in when you were talking about that program, which looks like a great opportunity for farmers in Idaho. The first question that we have is, how is depreciation calculated on machinery, vehicles, land, etc.?
Okay, great question. Land is not depreciated. Land is considered well-managed. Land does not depreciate. It doesn't wear out. Machinery does. And what you do is you figure, okay, here, I'll give you a really easy example. Let's say you have that $5,000 pink tractor. It's maybe not that great a tractor. And you are going to use it for 10 years. And at the end of 10 years, it's going to be worth nothing. It's going to be completely broken down. So you have a $5,000 investment that's going to last 10 years. A simple economic depreciation straight line, they call it, it's even every year, would be $5,000 divided by 10 years. So it's costing you $500 a year to have that tractor, and it will be worth nothing at the end of that time. So that's a very simple way to kind of figure out how much it's costing you. And I could have done a more complicated example. Say you were going to use it for 10 years, you estimate. These are all going to be estimates. And then you're going to sell it because you're going to get a better tractor. So you're going to sell it. And if you're going to sell it for, say, $1,000, you take that difference. So it's going to end up being a net cost to you of $4,000 over 10 years. Then it would only be $400 a year. So you can do a very simple kind of back of the envelope calculation to figure out economic depreciation. Now, hopefully, if you've got a farm, you're doing a Schedule F. Even if you're thinking about going that way, it is very, very important to start looking at the tax implications. And there are very specific tax depreciation laws in terms of what you can put in as a depreciation expense. And they're quite different from economic depreciation.
It sounds like perhaps an accountant would be able to provide some assistance on looking at what those depreciation schedules would be for different pieces of equipment, and that they might vary because each piece of equipment would have a different lifespan.
Yeah, and you can find that if you do your own taxes too online. There's a lot of information, but definitely a tax accountant is usually worth their weight in gold.
Okay, great. Thank you. The next question we have is, can you do the benchmark if you are just starting out?
You know, I think probably not, because you're going to be needing to provide data for a couple of years. But that is a really good question, because if you're going to go in and try to get a loan and get going on your farm, you do need to have financial statements of some kind. So, you know, they want to, I can follow up on that, but I would imagine that it's more for people that have several years of data.
Okay, so if people are interested and want to get an answer to that question, should they go ahead and go to the link and apply and just state how long they've been in operation and get feedback that way? Or would you prefer that they email you directly?
It might be easier just to email me directly. My email is on the presentation, and I would probably forward that to the project director, Ashley. She is the one who's making those decisions.
Okay, great. So if you want to just email kpainter@uidaho.edu, that would be great, and she can get your question answered about being part of that benchmark project. Okay, our next question. Depreciation schedules for assets can be made by the county or an accountant. Which do you recommend? What differences might you see?
So the question is, depreciation schedules can be made by the county or an accountant?
Yes, that's what it says. And then which do you recommend? What differences might you see?
You know, I guess I'm not familiar with depreciation being determined at the county level. I'm familiar with economic depreciation that I described, and then also tax depreciation, which is, there are different schedules. You have to say what you're doing. Sometimes it's double declining balance, sometimes it's straight line, sometimes you want to depreciate off a lot in the first year, which you're allowed to. And you can depreciate the whole thing up to a certain value. Say you have a lot of taxable income and you think, well, you know what, this is an unusual year. This is the right time for me to go invest in a piece of machinery, because the depreciation laws are very favorable for farmers. So you could do that and then write the whole thing off in 1 year if it's under a certain quite large value. And farmers often do that to kind of even out their taxes. In a high tax year, they may buy a depreciable asset and depreciate it out completely if possible. So that kind of information is available from the IRS and your tax accountant. And I'm sorry, I've never heard of county depreciation.
Hey, thank you, Kate. Our final question is, what about assets that are fully depreciated but still in use?
Okay, now that is a great question. So it may be that from a tax standpoint, they are fully depreciated, because you're allowed to, up to like a huge amount of money, like $400,000. You can depreciate out the entire thing in 1 year. And that strange law was put into effect to A, help farmers, and B, encourage them to invest and help the whole economy. However, that very expensive tractor still holds a lot of value. So your own economic depreciation would be quite different. So if I bought a $100,000 tractor because I had a very, very great year, then and I knew that I was going to use it for 30 years. And at that point, I would have taken really good care of it and it would still be worth $50,000. So in my own economics, my own economic depreciation would be 100,000 minus 50,000. So a 50,000 total outlay over, what did I say, 30 years? Let's say 50 years. It's really a great tractor. So that would be 50,000 divided by 50 years. It would be costing you $1,000 a year in true economic depreciation, the decrease in the value of that factor of production. And we're really trying to look at how much each factor of production costs us so we can find out if we're really making money. A sad thing that happens sometimes is people farm and the value of their assets is going down. They're using up their tractors and their prices are terrible, or they have natural disasters, or for whatever reason, those assets are not generating income over expenses. And so they see their assets eroding. So their investment in that farm is just falling apart under their fingers, and they have to think of something. Either they know it's just an anomaly and it's going to get better next year. They go in and talk to the banker and say, whatever happened, it was a hailstorm, it won't happen again, or I'll have insurance, please let me borrow some money. But if it is the case that they are maybe in the wrong industry, it's costing them too much, labor's too high, the price of the product is really fallen off for whatever reason, that they're not making money. Ideally, you would, like this little sheep farm, which is very similar to mine. It was a hobby farm. I just wanted to be having a small return on assets that I could keep reinvesting that money and slowly growing my sheep farm on a part-time basis. So it was paying for itself and paying for my time. And it would fluctuate from year to year. But if I started seeing that just getting nothing back from all that money and time invested, because I was looking at the value of these assets, then it'd be time to go back to the drawing board.
Okay, thank you, Kate. And we don't have any other questions that have come in. Would you like to say anything about the handouts that we provided and what people might do between now and next week's webinar to, kind of take a closer look at developing a balance sheet for themselves, and then any preparation for next week?
Yeah, so the balance sheet that I did for my farm is in Excel. And so there's formulas that kind of do the subtotals and the ratios. And I would suggest that if you printed these out and you can read about the story and think about the questions, which we kind of did in class, and think about, is the farm in a stronger position? And do we know why? We don't really know why. It looks like it's in a slightly stronger position. If you think of questions or you try to do it for yourself, we can talk about those next week, or you can also email me. Next week, we're going on to the next topic, and I'll have a very similar format. So I'll go through briefly the definitions and what it is and why, and then we'll show how I used it on my sheep farm. And basically the income statement will explain what happened between those two snapshots. And that is another very important piece of the puzzle that you'll want to bring in to a lender if you want to show them where you're at. And it is also another thing that would be done if you took part in the benchmarking study.
Okay, great. Thank you. If you wouldn't mind stopping sharing your screen, and then I will share my screen, and we'll wrap up today's webinar. Thank you.
Great.
Okay, so Again, here are the upcoming webinars that we have. Next week, we have on Monday a fresh produce and pathogenic microbiology webinar that Stephanie Smith from Washington State University is going to present. So if you are a produce producer, that could be a helpful webinar for you. And then on Tuesdays are when we're having the Financial Fitness for Farmers webinars. So as you can see, next week on March 10th, we'll have the income statements. And then on March 16th, we're going to have a webinar that's looking at assessing beneficial insect habitat on your farm. And then our final two webinars in March will be parts 3, and I'm sorry, this should say part 4, from Financial Fitness for Farmers, Enterprise Budgets, and Cash Flow Statements. So if you're not registered for those, please do register and register in advance. So when I send out the slide handouts and supporting materials, you will have those and you can download them prior to the webinar. We would really appreciate it if you could take a moment to provide some feedback on this webinar. This survey is going to generate in your browser right after I close this webinar. It'll only take a couple minutes to complete, and it will be helpful feedback as Kate moves forward in this series. Thank you for joining us today, and we look forward to having you on a webinar next week.